So take out your handout page 11, or your notes. Handout page 11. Also, I'd shared the notes to all the groups. So business income is among the specified sources of income, which is taxable under Section 3, subsection 2 of the income tax. A business can be operated either as a corporation, that's a company, a sole proprietorship, or as a partnership. Yeah, those are the various forms of business. You're saying that a business can either be operated as a sole proprietorship or a partnership, or can be operated as a company. Now, what's the difference? Now, for tax purposes, sole proprietorship and partnership. Remember, for a sole proprietorship and for a partnership, there is no separate legal identity between the owners, that the sole proprietor or the partners, and their business. So that means for tax purposes, they be assessed as one person. But for a company, there is a separate legal identity between the owners, that's the shareholders, and the business. So one is a natural person, the other one is an artificial person under the eyes of law. So, but for sole proprietorship, there is no separate legal identity. That's why for company, when determining the tax, you take the income minus expenses, then you tax at the rate of 30%. In case of sole proprietorship, business or partnership, we don't use 30%. We use the graduated rate of tax. The one used to file your pay. So that's what we use this, because in this case, the owner, that the partners or sole proprietorship are sole proprietors, there is no separate legal identity. But for the company, there is. Now, what are some of the factors to consider in evaluating whether a business is in the nature of trade? How can you assess that this is a business going on, or this is not a business going on? So number one is the profit motive. Number one, you look at the motive. Now, remember the underlying major objective of any business is to make profit. So if the motive is to make profit, that means the business is going on. Then number two, you look at the nature of asset acquired. Yeah, sometimes a nature of asset can tell you, can you buy a road to be a private car? Or a bus? So that this is a bus for my family. Yeah, so you look at the nature of the asset acquired. Then method of financing. Also, you look at the method of generating sales. You cannot advertise something we're not expecting a return. Then you look at the mode of asset acquisition. Good. So now I want us to look at what we call the taxable income. Now, what are taxable income? Now, reason here. For tax purposes, now, first of all, let's go to the accounting for accounting purposes. This is now accounting. Now, for accounting, how to determine the profit? You take the incomes, all the incomes, then you less expenses. What you get here is what you call now the profit before tax. Then you tax. That's for accounting purposes. What about for tax purposes? Now, for tax purposes, when taxing, it depends whether it's a complete or incomplete record. But in this case, we don't tax all the income. You only take what we call the taxable incomes. Then you raise. Not all expenses are deducted. You see, the expenses will reduce the amount of income. So if the expense reduces the amount of income, so the more expense, the lower the profit. The lower the profit, the lower the tax, right? So in this case, we have to restrict some expenses. So not all expenses will be allowed. So you only deduct allowable expenses. And what you get here, not just profit, that's what we call the taxable profit. That's for tax purposes. When taxing, you only take the taxable income. So not all income are taxable. So the income which are not taxable, they are known as non-taxable income. Then expenses, we have allowable If an expense is not allowable, that means it will be disallowable. And what are allowable expenses? Now, allowable expenses mostly are operating expenses, operating business expenses, which are actual cash outflows. That's the only expense that now will reduce the amount of taxable income. Expenses which are business related. So that means any private expense will not be considered an expense. Right together. That expense must be for operating purposes. Operating, that means day-to-day operation. We have some expenses which are capital in nature. They only incurred once, maybe in a year. That's not an operating expense. That's a capital expense. So it's part of disallowable expenses. Also, we only consider the actual cash flow. Depreciation or provision. You know, provision is not an actual outflow. Yeah? It's something of due to uncertainty. So in that case, provision will be disallowable expenses. Now, what are these taxable income? Now, note that all the income from day-to-day operation are taxable. Right together. All the income generated by the business from day-to-day operation are what? Taxable, except non-taxable income. Are you together? I repeat again. All the income generated from the business are taxable, except non-taxable income. So what you need to know, what are those non-taxable income? Good. So now let's go through that. So in page 12 now, you have the notes, you can look at that. Now we have the taxable income. First of all, ignore the taxable income. What you need to know, we have said that all the income are taxable, except non-taxable what? Income. So we need to know the non-taxable income. Now let's look at non-taxable income. Number one, we have income from foreign investment. All the foreign incomes are not taxable. Why? Because they were taxed at the point of origin. So to avoid the double taxation, they will not be taxed. Then number two, reduction in general provision for doubtful debts. Yeah, this is what happens. A reduction in provision is an income. An increase in provision is an expense. An expense. I repeat again. A reduction in a provision is an income. So being an income, it's only an income for accounting purposes. But for tax purposes, provision is not an actual outflow. So therefore, it will be a disallowable what? I mean, therefore, it will be an untaxable what? Income. In case was an increase in provision, becomes an expense for accounting purposes. But for tax purposes, we are saying that all provision are disallowable expenses. A deduction becomes an income, which will not be taxable. It will only be an income for accounting purposes. In case it's an increase in provision, becomes an expense for accounting purposes, but it's a disallowable expense for tax purposes. Good. Number three, we have additional capital introduced. If you inject more capital, that capital will not be taxed. Then we have capital gain, e.g. sale of an asset at a gain. Capital gain, they are not taxable. Yeah, that one is a specific. We'll come to discuss that, the topic itself, capital gain. Now, for example, if a company sells an item of motor vehicle, the fair value or the carrying amount was 25, but now the fair value, they sold it at 3 million. So that means there was 500. Now, this is what you call the capital gain. Now, that capital gain will not be taxed. Yeah, we'll come to discuss that later. They have new rates. Then we also have unrealized profit. An income which you have earned but has not yet been realized will not be taxable. Will only be taxed when it will be realized. Also, dividends where the entity have at least 12.5% equity ownership. If a company controls another company or has shares in another company, more than 12.5%, the dividend income from that company will not be taxed. Yeah, most of the dividends are not taxable, although we come to discuss that. Yeah, because we have some dividend from companies. Actual dividend from the company, their withholding tax is final, apart from SACCOs, I mean cooperatives. Yeah, so the withholding tax is not final. That's what we call non-qualifying dividend. So discuss that later. Also, inheritance on an individual basis. Also, interest from government infrastructural bond with maturity period of more than 2 years. If you invest in government, the amount of interest earned is taxable. But if you invest in infrastructural bond, whose maturity period is more than what? 2 years, any interest and will not be taxed. Good. Also, interest from the post bank, but all the other interests are taxable, apart from the interest from the post bank and the interest from government infrastructure bond, whose maturity period is more than 2 years. Then insurance compensation for non-current assets. Insurance compensation for non-current assets. So that means in case of loss of current asset, for example, there was fire, inventory was destroyed. Inventory, remember, is part of current asset, right? And then you are compensated by the insurance company. So that amount will be taxed. But in case was for non-current asset, that amount will not be taxed. Let me repeat again that all the incomes are taxable, except what? Non-taxable income. Now the question is, what are non-taxable income? Which one have you understood? Insurance compensation for what? For non-current asset. Unrealized income or unrealized profit. Sorry? Additional capital. Capital gain. That gain on sale of non-current asset is not taxed. Sorry? Inheritance on an individual basis. Though that one. Now, in this case, I want us to discuss business income. But inheritance was on an individual basis, on an individual basis. Yeah, all the income from foreign investment are not taxable. So I want you to take some incomes there, which are common in most of the questions. Now let's go through again the non-taxable income. Number one is the income from foreign investment. Tick that. Tick that. That's a common one. Reduction in general provision for doubtful debts. You don't have to tick that. Additional capital employed. You don't have to tick that. Capital gain. Can you tick that? Capital gain. Tick that. Then we have unrealized profit. Also tick that. Rusi, we are in page 14, page 11. Or I had already shared the notes on business income. That's what we are discussing. Actually, for tax purpose, be printing the notes in advance. I shared them very early. If there is someone who is always organized, it's John Mark. Did I share the notes, woman? Yes. Actually, I shared at 1. Yes, today. I shared today at 1. I don't forget. And actually, tomorrow I share for all the units we'll do on weekend. I share them in advance so that you prepare yourself on Friday, so that on Saturday, on Sunday, most of you don't go to work. So make sure you have all the material. I usually do my part. Yes. Then we have dividend where an entity has at least 12.5% equity ownership. Stroke, you can add something. Dividend from companies. Stroke, dividend from companies. Stroke, dividend from companies. Yeah. You see that I'll discuss on that. Why dividends from company are not taxable? Because dividends attract withholding tax, which is final. Yeah, so it only cut at the source. Yeah, so in the hand of recipient will not be taxed again. But for company purposes, in that case, if a company controls another or owns another company for more than 12.5% of the equity ownership, it will not be taxed. And then number 7, inheritance on an individual basis. Interest from government infrastructure bond with the maturity period of more than 2 years. You can tick that. Tick that. Interest from post bank, and then insurance compensation for non-current assets. So any other income which is not among the 10 listed are all taxable. So in short, depending with the nature of the business, so any income you generate from day-to-day operation will be taxed. Are you together? Good. So now let's go back now to taxable income. so that you can understand what are those taxable income. Now, number one, you have gain arising from selling and buying. Yeah, right in bracket. Day-to-day gains, day-to-day gains, day-to-day gains. Yeah, the income you generate from day-to-day activities. Yeah. Then number two, any amount of insurance compensation for the loss or damage of stock. Then I've written for you in bracket for you to remember. For non-current asset, it's not what? Not taxable. In case it was insurance compensation, in relation to loss of non-current assets, will not be taxable. But in case of loss of stock, it will be taxable. Number three, bad debt recovered, which were previously considered as allowable when they were written off. Okay, we'll come to discuss about the bad debt. Bad debt, we have two types of bad debt. We have what we call general provision, what you are not sure of. And then we have specific, what you are sure of. Now, specific bad debt are allowable expense. Now, assuming during a given year, there was specific allowance for doubtful debts worth 3 million. Then during the period, the amount had been allowed because it was specific, then you recover the amount. So how do you recognize amount of bad debt recovered? As an income, together. Now that income now will be taxable because when it was written off, it was recognized as allowable expense. Yes, good. Number four, realized foreign gains. I want you to add something there. Realized foreign exchange gain should be foreign exchange gain. Foreign exchange gain. Foreign income are not taxable. Should be foreign exchange gain. And then we have balancing charge and trading receipt. Yeah, balancing charge will come to discuss. It's in relation to this sale of an asset. For example, your company deals with leasing of cars. Leasing of cars. And then during the year, you decide to exchange or to sell one car so that you can buy another one. And you realize a gain. So that gain is what we call a trading receipt. Are you together? A trading receipt. Because that asset is used in day-to-day business. So in that case, in case of that gain, it will be taxable. But for other assets, we say that a capital gain is not taxable. I'll also have come to explain that, what we call the balancing charge and then the trading receipts. Yeah, mostly for the business which engage in those non-current assets. Yeah, so any gain realized will be what we call the trading receipts. That one will be taxable. So now those are the taxable income. Now let's now look at expenses. See that expenses, they are classified into two for tax purposes. We have allowable expenses, we have disallowable expenses. What's the difference? Now, allowable expenses are those expenses that reduces the amount of taxable income, therefore reducing the tax liability. Are you together? Allowable expenses are those expenses that reduces the amount of taxable income, therefore reducing the tax liability. Good. Now, what are allowable expenses? All expenses incurred by the business are allowable. Are you together? All expenses incurred by the business are what? Allowable, except disallowable expense. Except disallowable expense. So now let's discuss about disallowable expense. Let's go directly to disallowable expenses. What are those disallowable expenses? Now, they are expenses not or exclusively incurred on day-to-day operation. In short, they are not operating expenses. All the operating expenses should be allowable, but any non-operating expense are disallowable. That's why we're saying that the expenses not or exclusively incurred on a day-to-day operation are operating income generating for income generating. And what are those? Number one, capital expenditure on acquisition of non-current asset. Yeah, capital expenditure. If you buy a motor vehicle worth 3 million, that's not an expense. That's what we call a capital expenditure. You need to capitalize the amount to the balance sheet. That one does not affect the income statement. Good. So therefore, any capital expenditure is a disallowable expense. Later, you come to claim what we call the wear and tear. wear and tear on that asset. Good. Number two, any depreciation, impairment, and amortization. Yeah, that's not an actual outflow. Now, for tax purposes, they don't recognize depreciation, impairment, or amortization. Rather, they have their own standardized rate. That means all the assets of the same class, they have the same rate. That's what we call wear and tear or capital allowances. If it's a motor vehicle, they have the same rate. So therefore, for depreciation, in case the accountant has recognized a depreciation, impairment, or amortization, for tax purposes, the taxman will say that that's a desirable expense. So for them, they have their own rate known as what? Wear and tear or like capital allowance. Then number three, we have personal and private expenses. Now those are expenses that they does not relate to the business. So therefore, any private or personal expenses, they are disallowable expenses. Then number four, we have general provision for bad debt. But for specific is what? Allowable. Yeah, general provision for doubtful debt. In short, all the provision are disallowable. So if you see any provision, no, it's a what? It's a disallowable expense. So for bad debt, the only thing we allow is when they are specific bad debt. Then number five, we have all provision. Number six, tax-related expenses. Any expense relating to tax is considered as disallowable expense. For example, interest on overdue tax, also the penalties, also hiring tax expert to give you tax advice. That expense will be considered as a what? A disallowable expense. Then you also have legal fees and other professional fees of capital nature. Now note this. Legal expenses are allowable. Are you together? Apart from those legal expenses which are of capital nature. What are those expenses which are of capital nature? Now let's see that number 7. Legal expenses and other professional fees of capital nature in relation to number 1, borrowing, valuation of property, and preparation of partnership, deed, right there, add something, including preparation of MOA, including preparation of MOA, including the preparation of MOA. Now, those are what we call the capital expenditure. Yeah, because, for example, in this case, we are saying that in relation to borrowing, any expense incurred in relation to borrowing under IAS 23 should be capitalized. It's a borrowing expenditure, right, together. So it should be capitalized, therefore should not be expensed. Good. Then number 8, capital repairs, including cost of extension and what? What do you mean by capital repairs? Now, if you buy a motor vehicle, maintenance, you change some parts, that's an operating expense. Are you together? What if you change an engine? What if you change an engine of a car? The cost in car. That's not an operating expense. Are you together? That's what we call a capital repair. If you have a house, you incur some major expenses. I mean small expenses. That will be considered as a allowable expense. What if now you want to change the tires? Is that an operating expense? No. That's a one-time thing. So therefore, it will be considered as a capital expenditure. That's what we call the capital repair. Good. Then number 9, we have fines and penalties. Yeah, in short, any expense of wrongdoing will be considered as disallowable expense. For example, there was any expense incurred by the company for the breach of contract. Any expense. See, that's what we call expenses of wrongdoing. Any expense of wrongdoing will be considered as disallowable expenses. And then lastly, number 10, other expenses regarded as non-business, such as what? Donation. So donation, let me explain something. Donation is not business related. You are giving back to the society. Are you together? Yes. But remember, you are profit oriented. You're not there to give back to the society. So therefore, donation is non-business related expense. So therefore, regarded as what? Disallowable. Not unless the amount of donation was made to charitable organization. And what are charitable organizations? Orphanage, church, are you together? What else? Any other charitable organization? What about border? That's not a charitable organization. Yeah, so you're saying that donation is a desirable expense, not unless it was made to the charitable organization. Good. Yeah, that's what we call desirable expense. I want us to go through it again. Number one was capital expenditure. Number two, we had depreciation, impairment, and amortization. So whenever you see depreciation, know that it's a desirable expense. Then number three, we have personal and private expenses. Those are non-business related expenses. So therefore, it will be considered as desirable. Also, we have said that bad debt, the general provision. If it's specific, that one becomes allowable. General becomes desirable. Then number five, we have all provision. All provision are desirable, as well as the tax-related expenses, legal fees of capital in nature. Then number eight, we had capital repairs. Number nine, we had fines and penalties. I see that those are the expenses of wrongdoing. And then non-business expenditure, such as donation, not unless they are made to the charitable organization. So now those are what we call desirable expense. So that means apart from those desirable expenses, all the other expenses are what? Allowable. Yeah. Now let's go back to the allowable expenses. Go back to allowable expenses. Go back to allowable expenses. Now, they are expenses which are wholly or exclusively incurred in the production of what? Income. Yeah, the expense you incur so that you can generate that income. In short, they are what we call operating expenses. The guiding principle is subject to the provision of the Income Tax Act, and they include those allowable expenses. Some of them we have specific trade bad debt, also capital allowances. Yeah, capital allowances, that's what we have the wear and tear. So before, actually that way back in 2021, going backward, so we used to have various classes, wear and tear, IBD, ID. Also for wear and tear, we had class 1, class 2, class 3, class 4. But nowadays they have made it simpler. That's why it's no longer part of the syllabus. Because before you have to be trained on how to charge different rates. But nowadays, it's now attached to the graduated scale rate of tax. Can you take out your past paper? The first page of your past paper. So you don't have to cram them, because you are given everything. Also, you'll be given that one in your question paper, the first page. The first page. You only check for the one for 2022. So from 2021, that was before. Can you see the investment allowances? First page, that's why you have that. The first page of the question paper. Yeah, so we come to discuss that later. But that's why you have all the investment allowances classified. They are classified only into 4 categories, but you don't have to cram them. Before, I used to say that you need to cram. You need to know what goes to class 1, what goes to class 2, what goes to class 3, what goes to class 4. But now they have standardized. They have merged most of the assets. Yeah, and they will always be given, I will be provided with that chart. Good. So that was the capital allowances. Then number 3, subscription to a trade organization or association. Number 4, legal costs in connection with acquisition of risk of not more than 99 years. Interest on loan for business what? Development. Yeah, interest is allowable expense. Then marketing and advertising expense. Marketing and advertising expense. But the cost incurred on neon sign. Do you know what's a neon sign or signboard? So you know signboards, right? Yes. So now that one is not a normal expenditure. Signboard. I'm on every month. No, that's an asset to the company together. And actually that is what we call capital expenditure, of which you can claim also for wear and tear or for investment allowance. So for the part of marketing and advertising expense, in case there was any expense incurred, yeah, for billboards or the neon sign, that one becomes a disallowable expense. You claim the wear and tear. Another expense, we have it's number 7. Loss brought forward from the previous year with a limit of, and now they have changed the years. I'll come to clarify that later. What does it mean? Loss brought forward. If a company makes a loss, are you together? It will not be taxed. We don't tax loss. That amount of loss for the next period will be treated as allowable expense. But for a period of how many years? 4 years. You can carry it or you can write it off against the profit for the coming 4 years. 4 years. Good. Then number 8, legal fees paid on listing securities. Also, we have costs incurred for prevention of soil erosion, and then scientific research related to business. That's all about taxable income and taxable income. Allowable expenses, disallowable expenses. Now, what are allowable expenses? What do you understand? Allowable expenses as allowable expenses in layman's language. Expenses incurred to generate the income, and then they relate to the business. What about disallowable expenses? They are not related to business, right? Or they are capital expenditure, or they are non-cash expenditure, such as depreciation. Good. Now let's proceed. Now I want us to look at specified sources of income. Look at the specified sources of income. Number 1, we have business income. Number 2, we have investment income. And number 3, we have property income. Then number 4, we also have employment income. Then number 5, we have farming income. And then we have the post-employment. What do you mean by specified sources of income? Now, in layman's language, it means that specified sources of income, they are incomes which cannot be offset against each other. Are you together? Income which cannot be offset against each other. What's a business income? Is a day-to-day income, depending on the type of business. For example, as KCE, the income we generate from the student or from day-to-day operation, that's what we call business what? Income. For a bank, what do banks generate from day-to-day operation? The interest income, foreign exchange gain, right? Now that's what we call part of business income. What about the insurance? The premium, are you together? They are part of business income. So this is the income from day to day or from the operating activity, the core operating activities of the business. Then we have investment income. Once you generate the profit, you might decide to buy shares of another company. Or if you buy shares in another company, or for example, invest in bonds or debenture, what do you earn? Number 1, you earn interest. Also, you earn the dividends income. That's what now we call investment income. Also, we have property income. If you have a property, which income do you earn? Rent. We have rental income, or what? Loyalties. Yeah, we have intangible properties. Yeah, for example, you have a patent, or that you earn royalty. Then you have employment income. You know what is that? What is employment income? Salaries. And not just salaries. Salaries, commission, allowances, all that, including the allowances. Then we have farming income, and then we have post-employment. But these are the key measures. The business, investment income, where you have the interest and the dividends, property income, and then the farming income. So now, what's the motive of us having the specified source of income? You see that for specified sources of income, you cannot offset the profit or the income. What does it mean? Assume that the business during the period made a loss. Instead of profit, they made a loss. For example, 200 million. That's from day-to-day operating activities. Then they have a property. So they earn some rental income. Rental income of, if this was loss, this is 50. Then also they had farming income, maybe 100. Now give me the total taxable income. How much is that? It's an amount of 50, right? Yes, but I add one. I repeat again, you see that specified sources of income, they are incomes which cannot be offset. This is what I mean. From the business or from day-to-day operating activities, you made a loss of how much? 200. That will not be considered. Are you together? So we don't tax losses. But from the other sources, you made a profit. Because if you take negative 200, you add 50, you add 100, still get a negative 50. No, KRA does not operate that. They're opportunists. So they cannot offset. If this you made a loss, they not tax that. But from other incomes where you got gains, that's what they consider. So in this case, for tax purposes, the tax amount will be 150. Now this is what now they'll tax at the rate of 30%. Yeah. But in case this was profit, you can add. So you cannot offset one source of income, and you cannot offset these sources of income. So that's why they are called specified sources of income. Good. Any question? Yes. And post-employment. Employment is your salary. Post-employment, once you retire, pensions, you'll be paid in lump sum. That's what we call post-employment. Post-employment income. Yes, pension. Yeah, they are totally different. Yeah. Good. Any question? Any other questions so far? No question. Give me 3 non-taxable incomes. Don't take it. 3 non-taxable income. Foreign? Okay, what was my question? Or non-taxable? Okay. Foreign income? Inheritance. Sorry? What is 2 years? Infrastructure bond, no. Interest from government infrastructure bond with more than 2-year maturity period. Now give me 4 allowable expenses. Allowable expenses. Specific budget, that's correct. Legal fee. Okay, now let's not work with allowable. Let's work with the disallowable expenses. Depreciation, capital expenditure, correct? Fines, donation, all that. Yeah, you are correct. All provision, are you together? Tax related expenses, all that. Good. Now let me let's go back here for the forms of business. Let me see this. Remember, you see that a business can either be operated as a what? A sole proprietorship, a partnership, or a company. So how do we tax them? So I want us to take a small break. Then I come, we discuss on how do we tax sole proprietorship, partnership, and companies. We take a 3 minutes break. Now we can proceed. Now let's start with the taxation of sole proprietorship. Sole proprietorship. Now, a sole proprietorship does not have separate taxable capacity, and the profit are taxed on the owners using the graduated scale rate of tax. Yeah, for both sole proprietorship and partnership, there is no separate legal identity between the business and the sole proprietor or the partner. Therefore, the profit from the business will be taxed on the owners using the graduated scale rate of tax. Salaries paid to the owner, comma, personal expenses and drawings are not allowable expense. Now, for a company, salaries and wages, they are part of allowable expense. But in a partnership, also salaries and wages are part of operating expense. Not unless it's paid to who? To the partner. Assuming this is your business, which is a partnership or a sole proprietorship. You have 10 employees. Also, you are engaged in day-to-day activities. So that means you're also on a payroll. So the amount paid to other employees is allowable expense. It's an operating expense. But the amount paid to you, even if you engage in day-to-day operating activity, will be non-taxable. I will disallowable expense. Why do you think is the case? Why do you think is the case? We have said that in this case, there is no separate legal identity between the business and the owner. Are you together? So it's like, that's under the eyes of the law. Are you together? So that's why any salary paid to the partner or sole proprietor will be regarded as a disallowable expense. What if you pay rent, but the business you're operating is owned by you? But in the expenses, you have shown rent. I usually do pay rent. Now the question is, unalipa kwa nani? No, inaenda kwa account yangu because you're operating in my what? My premises. So also in this case, the amount will be regarded as a what? A disallowable expense? Not unless you are paying to the external entity. But in this case, you are paying back to the owner. So there is no separate legal identity between the owner and the business. Good. Now let's look at taxation of partnership. It's the same as sole proprietorship, that a partnership does not have a separate taxable capacity, and the profits are taxed on partners using the graduated scale rate of tax. Each partner is taxed on the aggregate of the following from the partnership. So how do we tax partner? Now in a partnership, remember in this case, we have more than one person. Now, once you take the income minus the allowable expense, you get the profit. And once you get the profit, that profit will not be subjected to 30%. Remember, these are partners. Therefore, will be taxed based on the graduated scale rate of tax of each partner. So what do we consider? Number one, any form of remuneration from the business, such as salaries, bonus, or commission. Yeah, any remuneration you got from the business. Then number two, interest on capital, rest interest on drawing. And then number C is the profit share from the business after the adjustment. What does it mean? Assuming you have two partners, we have partner A and partner B. They're operating a business, and this business made a profit of 3 million. So how do we determine now the amount to be paid by A and B? So we prepare what we call the partners allocation schedule. What do you allocate? How do you allocate? So we have two partners, partner A, partner B, then you get the total. So that number one, you consider any form of remuneration, such as salaries, bonus, commission, all that. So you take salaries, bonuses, or commission. Then you get the total. Then you add any amount of interest on capital. Yeah, sometimes the business might appreciate that you have already provided a capital. So you need to add, you need to pay you an interest. So any interest you get on this capital, it's an income to the owner or to the partner. Therefore, it's an income you add. Also, as the owner, you might take some goods or take some cash. That's what we call the drawing. And then the business, your business charges you interest on those drawings. So you deduct interest on drawings. Yeah, that's right. Can we go back to point number 2 on how to allocate? Now, point number 2 was interest on capital, raise interest on drawing. That's why taking the interest on capital, you raise interest on drawing. And then lastly, depending on what you have adjusted, that's when now you factor in the profit or loss share. And this is the profit you determine now from the business. Income minus the expenses. The profit you share, if it's a loss, you also share. And what you get here is what now we call the total taxable income for each partner. That's from the business. Then from there, you can add any other income for specific partner. For example, assuming partner is a farmer, so that means he had earned farming income. Also, let's assume B has some rental houses, so that means he earned rental income. You add any other income which is taxable by A and B as partners, and that's how now you get the adjusted taxable income. Adjusted taxable income. So in case of partnership, that's how we determine the partner's allocation schedule. You take the salaries and bonuses or commission, then you add any amount of interest on capital, then you raise the interest on drawings, then the profit or loss share. And then you add any other income other than what are mostly they are specified sources of income. Then now, lastly, let's look at taxation of corporation. Taxation of corporation. Now, how do we tax companies? See that for a company, there is separate legal identity. If there is separate legal identity, that means there is a separate taxable capacity between the business and the owners, the shareholders. Now, a company has a separate legal identity. That is, it has a separate taxable capacity, a separate taxable capacity. The profit are taxed at the rate of 30% for resident companies and 37.5% for non-resident what? Companies. Yeah, non-resident company. That means that company was not registered in Kenya. So in case of any profit made when operating in Kenya, they'll be taxed at the rate of that 7.5. A resident company at the rate of 30%. Then transaction between the business and the shareholders. Now here you have the business. Here you have the shareholder or the directors. Any transaction between the two will be considered as a business-to-business transaction, as opposed to the partner. Are you together? Yes, because in this case, you're saying there is a what? A separate legal identity between the business and the shareholder. So you're saying that transaction between the business and shareholder are considered to be business transaction. Good. Director salary is allowable expense. Yeah, that's how we pay the directors. Most of the directors, they are shareholders. For you to entrust with the company, you must be one of us. That means you must be having an interest in us. But in case it's a partnership, we say that the salary to any partner, that one becomes a desirable expense. Good. Then I want us to look at what we call installment. Installment tax. Is there on page? Let's go to page. Yeah, page 16. Page 16. If you're using a handout, that's what it is. Installment tax. installment tax. When do the company pay their taxes? Let's start from there. When do the company usually do pay their taxes? We are talking about the corporate tax. If the year ends on 31st of December 2020, sorry, not 2020, let's work with 2022. And the company made a profit of 100 million. That means 30% of that is an amount of that. When do we pay that 30? That's based on how you understand, not necessarily how they pay. Okay, what do you understand? 2020? 2022, but installment, Yeah, that's from Ruto. What about the other? What do you think? Not necessarily what happens. What do you think? I've given you a scenario. Okay. The thing is, if the financial year ends on that 1st of December 2022, that means you now start preparing the financial step after the year has ended, so that you determine how much was the income for the period, how much was the expense for the period. This is the profit. And mostly, if the year ends on that 1st December 2022, that's not when you prepare the financial statement. You are given 3 months from the year end. Are you together? So that means from that 1st December, you have up to March 2023 to prepare the financial statement, for the financial statement to be audited before you call for an AGM. Now the question is, during this period, determine that you made a profit of how much? 100. 30% of that is 30 million. If that million is a proportion you share with the government, so when will you pay? Oman Lep, you want to try? Oman Lep too, You pay in installment. But okay, how? Sorry? 4 equal installment, but when? No, let's work with the financial years here. Let's work with the financial year. It's correct. You need to pay in installment. Are you together? Yes. Now, what happens even before you prepare the financial statement, even before the year end, you usually have already paid all the tax for that period. But now the question is, how did you know that you are supposed to pay a certain tax for the period? Now, this is how we determine the installment tax. Now, installment tax usually takes the previous year tax. That means when the financial year ending that 1st December 2022 was starting, that was 1st of January 2022, they already knew how much they're supposed to pay during that financial year. So you'll take the previous year tax, then you multiply by 110 per. Yes. That's the argument of Kenya Revenue Authority. If you paid a tax of 30 million last time, this time you should pay 110%. The tax should increase by 10%. So you take the previous year tax, you multiply by 110. Then what you get, you pay in 4 installment. 4 installment. That means on or before 20th of the 4th month, the 6th month, 9th month, and 12th month. On or before 20th. This is in April, June, September, and December. So here you'll take 25% of that. 4 equal quarterly. And that's why you see in the financial statement, we have some tax payable or current tax payable, or sometimes can be tax recoverable. Sometimes you can claim a refund. How? Because assuming that during this financial year, you paid an amount of 25 million. This is what you paid. This was 110 of the previous year tax. But during the year, the actual tax was an amount of how much? 30. Now we have determined the actual tax for that financial year. But you have already paid how much? 25. So that means you need to pay the balance of how much? 5. That we say current tax. What if now, during the financial year 2022, you paid how much? 35. But after the preparation of financial statement, the actual tax was supposed to be how much? That is the other overpayment by how much? What is this? Yeah, that's amount of tax recoverable, yeah, or tax refundable. So you apply for a refund, right? But mostly for the company, they don't refund. The easier way is one in a KRA. Just do what? Carry it forward. It will be offset against the previous year tax. Good. That's how we file the installment tax. Any question? Yes, Lucy, ask. Yes, of the previous year tax. It's coming to? We are not paying the rate. We are paying the tax. This is what I mean, Lucy. If last financial year, the tax liability was, you had paid a tax of 20 million. So the tax payable now during this financial year is not 110%. It's 110% of this tax, not the rate. So you take 110%. You get an amount of, now this 22 is now what you are taking 25, 25, 25, 25. So she's asking, if we add this one, you get 100, not 110. 110. So is this tax we are portioning, yeah? 4 quarter installment. Any other question? You don't have a question, I ask you a question. Can I ask a question? You don't want to ask a question. So I ask a question. You know, most of you are practicing. And then let me tell you one thing about tax. What you learn here, this is what you apply. You know, you say that in financial reporting, when you go to the ground, things are different. But they are not different, to be honest. What happens is only that, you know, here we are training you to be certified public accountant. You can work in any field. You see, if your field where you are working is not working, it's not like the others, but the same concept. It's only that how the insurance works is not how the banks works, right? But that's something you need to run in CPA journey. For example, in financial reporting on how to account for bank, how to account for insurance, how to account for agriculture. If you take someone from agriculture who was working there for 10 years, take them to the bank. Now, what are these? Even hata kubuka alisomanga kwa CPA kitu kama hiyo. Yeye anajua kitu alisoma ni only for agriculture. I think also financial report is almost the same. Yeah, mostly for consolidation. So that one, not every accountant can do consolidation. Yeah. Consolidation is not any accountant can. If you're entrusted by group of account, that means the group of companies. But now for tax, what we run here, that's how it will be applicable. Exactly. The only thing that changes are sometimes the rates. Yeah, for example, the graduated scale rates keeps on changing. That's why we have the tax bill acts. Also, like capital gain tax. The capital gain tax used to be 5%, but now it's how much? Now there is some student here I can see here. I saw in her status, ni alikuwa ameweka, sasa hajui. The new rates, New tax 2023. One was the capital gain tax. Capital gain tax. It was there. Now they don't remember. The rate used to be 5%. Now it will be charged at 15%. So you need to be familiar with this thing. So Now let's look at how to determine the taxable profit. Now let's look at the format of determination of taxable profit. You can go back to the notes. I've already provided the format. And then in case you have our app, so kindly you can revisit that video for what we are discussing today about arable and disarable. I did it as a specific video. It's under Introduction to Business Income. Introduction to Business Income. Yeah. You can watch it like 4 times. Just 4 times. Yeah. You see how tax will be flowing, eh? Arable, disarable, taxable, non-taxable. As simple as that. And then you know the specified sources of income. So how do you determine the taxable profit? So determination of taxable profit. Now, when determining the taxable profit, we have 2 formats. It depends whether is it a complete record or is it an incomplete record. So we start with the case of incomplete record. Now, in case of an incomplete record, this is where, as an accountant or the taxman, you are just given the trial balance. It's upon you to determine this is an income, this is an expense, an expense. In short, you prepare the financial statement. Complete record, this is where the accountant has already prepared financial statement. So it's upon you now as a taxman now to use the revenue authority assumption, not the accounting assumption. How do you adjust that? So in case of an incomplete record, it depends with the nature of the business. We have the trading business. They buy, they sell. So that means they take the sales. You raise the cost of sales. Then you get gross profit. Then from the gross profit, you raise all allowable expenses. You only consider the allowable expenses only. And that's how you get the taxable profit. Now, this taxable profit is what we call now the business income. Are you together? The profit emanated from the day-to-day operation. Now, once you determine the taxable profit, now you can add any other specified sources of income. So you add specified sources of income, such as what? Investment income, such as what? Rental income, interest income. We also have property income. We have rental income, royalties, as well as the farming income. Now, once you add that, you get what you call now the adjusted taxable income. Or for service company, for example, for a bank does not report a sale, right? Yeah. KCB don't recognize a sale. So you're offering services. So in this case, you only factor in, you consider what you call the taxable incomes or the taxable income. Then we deduct allowable expenses. That allowable expenses, they are those expenses that reduces the taxable income, therefore reducing the tax expense. And that's how you get the taxable profit or the business income. Then now you can add any other specified sources of income. Specified sources of income. That's how you get the adjusted taxable income. Now that's a case of incomplete record. We are preparing the financial statement from the scratch. What if now you're given a case of complete record? In case of complete record. That means in this case, okay, in this case, for tax purposes, you're not concerned with the balance sheet. You're only concerned with the income statement. So in this case, you're given the income statement, all the income, all the expenses. So now as a taxman, you're given all the income, you're given all the expenses, and you have the profit. So you'll start now with the reported profit. Okay. You see, as an accountant, you took the incomes, then you deducted what? Expenses, all the expenses. And that's how you get the profit. Now, this is a financial statement given. So now you start with the reported profit. Then you work upward. When determining this profit, you are deducted the expenses. But there are some expenses you are not supposed to deduct. What do we call those expenses? Disallowable. There are some expenses you deducted which you're not supposed to deduct. So what do? You add back the goods. So we add back disallowable expenses, such as what? Depreciation. Such as depreciation, also capital expenditure, yes, penalties, donation, etc. Now you add back all the expenses you are not supposed to deduct. Then for the incomes, it's part of the reported profit. But we have some income you deducted. Though before that, you add back disallowable expenses, then you raise allowable expenses never deducted, and that one is always one. The wear and tear, that's to factor in the depreciation and the impairment. So you raise disallowable expenses, then you raise allowable expenses never deducted. And I repeat, this one is all about the capital allowance. Capital allowances, you deduct that. Then for the incomes, you had added all the income, but not all income are what? Are taxable. You eliminate those which are not taxable. So you deduct also non-taxable incomes, such as what? Foreign exchange gain, right? No, foreign exchange gain, you see, I said that foreign investment income is not taxable. Foreign exchange gain is a taxable because that's a day-to-day activities. We have some clients who will pay in dollars, right? You need to change them. So that one is a day-to-day operation. In case the foreign exchange loss, that's an operating expense. So therefore it will be allowable. So you raise non-taxable income. Also, remember as an accountant, when you are adding the income, you added all the income, including rental income, farming income, but those are what we call specified sources of income. You see, in this case, I've said non-taxable income. Specified sources of income, they are taxable. It's only that they are specific. So you raise non-taxable income, you also raise the specific or the specified sources of income, specific income. Now, once you deduct that, what you get here is what we call now the taxable profit, or what we call the business income. Good. Then once you get the taxable profit, here is our taxable profit. Now you can add back specific income. Are you together? You deduct it because first of all, you want to determine how much was day-to-day income. That's what you call the taxable what? Profit. Then you factor them as a separate item. Good. So once you add, that's when you get now the taxable, the adjusted taxable profit. So note that you deduct the non-taxable income, you raise specified source of income so that you can get the business income. Once you get the specified, you get the business income, now you add specific income as a separate item because we say that you cannot be able to offset them. Any question of the format? Mostly you need to know this format. Reported profit, add back disallowable expenses, then you raise capital allowances. Then from there you raise non-taxable income. That means for you to deduct the non-taxable income, all the non-taxable income should be at your fingertips. Are you together? For you to add back disallowable expenses, all the disallowable expenses should be at your fingertips. Now take out your past paper. Explain something. Past paper, the first page of your past paper. The first page of your past paper. So that we look at now those investment or capital allowances. Cash flow tax. No. They're totally different. No, it's not the same format. For the cash flow, it's all about, for the cash flow, it's all about investing activities cash flow, financing, and operating. Yeah, the first page of your notes, of the past paper. Now, we say that you don't have to cram for the investment allowance. So you are given the investment allowance schedule. That's what you're using. So now for capital expenditure, nowadays they are classified only into 4. Those are the new rates. The new rates. Where part A is for the building. Before we used to have what we call ID and IBD. Then under ID, that's what we call industrial deduction. We had IBD, industrial building deduction. Now let me explain ID because in this case, it will be somehow applicable. When you talk about industrial deduction, when you take this house, this building, that's what we call an investment deduction or industrial deduction. Any cost incurred, then you also factor what you call the auxiliary asset attached to this building, such as what? Inseparable. No, partition, those are specific, right? Water tanks, powerhouse, parking, perimeter wall, all that. Are you together? That one falls under part of. If the cost of the building was, let's assume 100 million, then you incurred other expenses. For example, for water tank, backup generator, all that. Also parking, also perimeter wall, all that cost will be capitalized to the cost of this. That's what we call ID. Then we had what we call industrial building deduction. We get down a building. What do we have? Now that's why you have offices. It have showroom, conference room, not washroom. It's not for income generating. Now that's what you call what? You might have a warehouse, all that. Now that one falls under IB, of which we have commercial and commercial. For example, an office, is it commercial and commercial? That's commercial, right? Together. But all of them, they're in one class. So now let's start with part A. Part A, capital expenditure incurred on number A, buildings. For buildings, for hotel buildings, then you are given the rate of investment. It's 50% for the first year of use. That's what you can claim. Now, before you used to claim 100% for the first year, then you'll never claim again. 100% first year. But under the new rates, it's only 50% for the first year, and then 25% reducing balance of the residual. Now let's look at the residual value. Then we're saying that for the hotel building, it's 50% in the first year of use. Then 25%, that's for residual value per year on reducing what? Balance. Let's be here. This is what I mean. If the cost of the building was 100, we have year 1, we have year 2, we have year 3. How much will you claim in year 3? So you have said that year 1, you claim 50 of 100, which is then 25% year, reducing balance of the residual. So how much was the residual? 50, because it was 100, we claimed 50 on the first year. So the residual is 50. So year 2 you'll take 25% of 50, and you get an amount of 12 point. What about year 3? Can you compute for me year 3? Based on what you have understood. Compute for me for year 3. You're getting 9.375, So take me through. 25% of, that's, you see, it's reducing balance. So reducing balance, that means it's on, for tax purposes, we call it written down value. If you take cost minus depreciation, you get net book. If you take cost, you raise wear and tear, or the capital allowance, we call it written down value. So in this case, we take 25. You take this 50, then you have already claimed 12.5. So it's 25% of the residual. That's what it means. Good. So that was for hotel buildings. Also, the same applies for building used to manufacture. Now, when you talk about the building used to manufacture, for tax purposes, even this building is known as a manufacturing building. Are you together? Yes. So the same rate of 50% first year, 25% reducing balance on the residual value, as well as hospital building. Then you also have petroleum and gas storage facilities. The same rate of 50% for the first year of use. Then we have educational or hostel buildings. In case of hostels, you claim how much? 10% on reducing balance, as well as commercial what? Commercial buildings. When you talk about the commercial building, not necessarily this building. That's our IDs, IBDs, offices, showroom, what else? Gym, conference rooms, all that. So also for that is at 10% per year on reducing balance. Then part B, you have machinery. Now for business purposes, what are machinery? Curtain is a machinery. Partition is a machinery. Furniture is a machinery. Calculator is a machinery. Are you together? That's for tax purposes, So the first bullet is machinery used to manufacture. All the manufacturing machinery. Should be 50% for the first year of use, then 25%. Also hospital equipment, such as what? Hospital equipment. Bed. X-ray equipment, all that. Then we have ships or aircrafts. Ships or aircrafts. So at 50% in the first year of use, and then 25% reducing balance on the residual. Then we have motor vehicle and heavy earth moving equipment. You see, before for motor vehicle, you used to have class 1 and class 3. It was separate. Class 1 was for heavy earth moving self-propelling asset. Class at that 7.5%, that was before. Then we had class 3 for other self-propelling earth moving, such as Saron car, tuk-tuk, motorbike. What are other self-propelling? Bicycle is not a self-propelling. Eh? A bicycle is not self-propelling. Oh, propelling. Eh? Wheelbarrow, no. Wheelbarrow does have an engine. Should be self-propelling. Eh? Yeah, earth moving, self-propelling. Yeah. So under the new rate, all the earth moving, self-propelling, they have the same rate at the rate of 25% on reducing balance. Then computer software, they have not mentioned hardware. Even hardware is there. Before we used to have class 1, 2, 3, 4. Then there was another class 5, only for softwares at the rate of 20%. 20%. But nowadays, all the computer software, hardware, they have the same rate. Computer software, calculators, copiers, duplicating machine is at the rate of 25% per annum on reducing balance. Furnitures and fittings, 10%. Telecommunication equipment at the rate of 10%. Film equipment by local producers, 25%. Machinery used to undertake operation under prospecting rights and exploration under mining rights. That's under extractive industry for mining or for petroleum. It's at the rate of 50%. They are known as qualifying expenditure. I'll explain that. We'll be doing taxation of petroleum companies. Then we have other machinery. We talk about any other machineries, other machinery not in the above classes. Partition. Why do you take partition? It's part of other machineries. At the rate of 10%. Actually, anything that used to be class 4 under the old system, they are classified as other machinery at the rate of 10%. 10%. All right, let's go to part C. Purchase or acquisition of the right to use fiber optic cables by telecommunication operation is at the rate of 10% per year on reducing balance. Then number D, farm work. Let's call them farm work deduction. Is at the rate of 50% in the first year of use and then 25% to do use. Good. You don't have to cram that. Are you together? Yes, whenever you are given an asset, you need to determine the wear and tear of the investment allowance. You just need to go and confirm. You'll be given that rate. Just need to go and confirm. Any question? Good. So now I can leave you so that you can try to absorb that. Or you do a question. And now let's do a question from the next class. So kindly familiarize yourself, because I'm sure most of the part-timers